heading into Jackson Hole, we're not expecting a major policy shift out of the Fed.
I think Powell will be prudent, best of both Greenspan and Volcker, not claim victory.
Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit.
I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
I don't think we should be looking for any big surprises. My sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is almost the moment you've been waiting for, the most important hour of the week, arguably of the month. Chairman Powell addressing Jackson Hole, Wyoming in about 4 minutes from now. The third hour of Bloomberg Surveillance starts right now. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Going into this, your equity market on the S&P 500, slightly positive by 0.4%. TK, this event about global structural shifts in the global economy and all of that good stuff. We've got one question. Tell me about September. Tell me about September. Yeah. And beyond.
He's going to be data dependent. We know that. The shock of last year's speech being 7-8 minutes or what truly a shock, folks. I really can't say that enough. And, the headlines will come out here and Mr. McKee will warble gaily and away we go.
TK, I'll share this with you. 12 months ago, I raced off set to go to the bathroom.
I remember
to go to the restroom. And then I raced back again. I couldn't believe it was only 8 minutes long. There is a sense, Lisa, this is longer. It's more thoughtful. It's less just about inflation and much bigger themes. There is a hint from other people. I'm not sure where it's really come from. The neutral rate. Are we going to talk about R-star? I would suggest to take a guess that this has come about because the economic data has been so much stronger over the last several months or so that people are starting to have that discussion. They'd like him to have that discussion. Whether he chooses to have it 3 minutes from now is a completely separate question altogether.
And most people would say, no way, he's not going to do it. And you say, what are you going to do in September? He's not going to say. He's not going to say what he's going to do later on. But what is going to be interesting is the longer that the speech is, the less clear the message he's trying to convey. Short, very clear. Pain, we need to get there. We need to get inflation under control. Is inflation going to be the same enemy this year that it was last year? Is inflation at 3% pernicious or acceptable? And I don't think he's going to necessarily weigh in on this, but the tone that he takes will really give a sense of that.
I got this message just moments ago from a Bloomberg subscriber. Thanks for that. It said, come on, Jonathan, get with the program. You're in Wyoming, dress like Michael McKee.
Good morning, everyone.
Chairman Powell stepping up to the podium. Here's the chairman of the Federal Reserve.
Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome. But 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue, or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor-intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the two-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened, and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
We will keep at it until the job is done. Chairman Powell, 12 months later, after promising pain, without much sign of it, 300 basis points later, the goal is still the same. 2% is and will remain our inflation target. The price action off the back of this address in Jackson Hole, Wyoming, shaping up as follows on the S&P 500. Equities elevated, and it stays that way. The S&P up just a little bit on the S&P 500 right now. If we can run through the boards, we get equities up, and then we can get bonds, and we'll do it piece by piece and start with stocks. Stocks are still positive on the S&P 500. Yields look like this, Tom. They're lower by 3 basis points on a 10-year, 420.39.
Dollar comes in. Let's go right to it, John. Euro, a little bit of dollar weakness with the euro 107 earlier, and come out to a 108.04 maybe with a little bit of a euro lift here.
Knee-jerk reaction, Tom, but I would be hesitant to define this speech based on the intraday price action on the S&P 500 in the bond market. That was a Federal Reserve chairman effectively telling us all, Lisa, that the job is not done. And if we need to do more, we'll do more.
This was a Fed chair saying, stop talking about 3% as the new normal for inflation. 2% is what we're going to get down to. We are not going to stop until we get there. The long and variable lags are long, but they are going to come to fruition. He talked about how there is tightening that's going to hurt. But to me, that is the takeaway. They are not entertaining a 3% target for inflation, despite a lot of people saying that maybe that's what they ought to do.
A perfect Jackson Hole morning, and with the food spread that we've got laid out in support of our staff here, the crows descend. And while the chairman was speaking, it was the Jackson Hole crows. All the hawks are indoors. Because my first take from the first sentence of the speech is it was a hawkish speech.
If the labour market is not easing, monetary policy needs to respond. How much of a sign are you seeing that this labour market is easing?
I'll let McKee and the others judge. I'll let Dr. Lariat and Mike McKee judge this. I'm not going to judge it, but I'm just going to say all the hawks were inside listening this morning.
Well, two things. One, either the market doesn't believe that they're actually hawkish and just thinks that they're trying to jawbone them down. And the fact that he didn't come out and say we're going to hike again is basically an all-clear signal. And maybe that's what he could take the market reaction. And number two, are they really convicted to go through with this? Yes, they're going to get down to 2%, but if it takes to 2035, does it matter? Right? I mean, in other words, how imprudent is it to bring it down quickly?
Our first math of the morning here, 8:19 a.m. Mountain Time. Is 2% 2.0%? Or is it 2.4? Or is it 1.9 rounded up? I don't know.
The former Fed Vice Chair, Rich Clarida, in a secular outlook over at PIMCO, saying it's 2 point something. That might be something they tolerate. Tom, at the end of the day, if they're still shooting for 2%, except 2% is out there in 2025, that's a shift, isn't it?
Yeah.
Isn't that tolerating above target inflation for longer?
Yeah, but there's a lot of data to come before we get to that point. I think the heart of the matter is I don't have it in front of me, but in a given set of cities in Kansas or Ohio, the unemployment rate's under 3%. to me, that's the heart of the matter.
Mike McKee alongside us to go through this speech. Mike, your first thoughts. What did you think of that?
Well, it was a hawkish cast to it. He didn't say anything he hasn't said before, but basically they framed it in a way to send a message to the markets that don't get ahead of yourself and thinking that we're going to halt or cut rates. We're going to keep going with what we need to do, depending on the data. And I think he wanted to make it clear that another rate move is still on the table. It may not be for September, it may not be for November, but don't count us out. We'll see what happens as it goes forward. And he kept re-emphasizing that point, saying 2% is still a long way away, and we're going to go to 2%. To your point, John, the Fed has basically said, and Powell said again today, they will not hold back on cutting rates until they get to 2%, but they're going to keep rates higher until they get to 2%. Because, as he pointed out, real rates are up, and real rates will continue to rise as inflation falls, so they might calibrate down a few basis points to try to keep tightness at about the same level. But they're not going to get rid of all of their tightening until they are convinced they're heading towards 2%.
He started early, which I thought was interesting. He started about 10:02,
John, you noticed that?
44 seconds rather than 10:05.
That was deliberate to keep me from off the air breaking headlines. Jay Powell.
There you go. He wanted to prevent against the Michael McKee slip up. There's a real question. There was almost an urgency. Hey, first I want to talk about the 2%, and then I want to just talk about all of the vagaries and all of these things. And we haven't decided yet. We're very aware of them. We're understanding the balance of risks. How much is he uniting all of the other members versus just coming out and saying, stop thinking I'm going to say something, I'm going to reconfirm what I've said already and just let it be already?
Well, I think he's basically appealing to both sides here, because while the speech reads hawkish, he didn't promise any additional rate cuts, rate increases. So he can go either way after this. This is more aimed at the bond market than it is aimed at members of the committee. It was interesting, though. I kind of found it fascinating that he clearly is reading the papers and listening to what people on Wall Street are saying, because he responded to them. He said, we don't know what our star is, so we're not going to talk about it. And he said, we are not going to change our 2% target.
No new target.
Yeah, so if that's what you're writing about, take it off of your company website.
You know, I love Total Drama Island. I watch an episode every week I can. This is like Total Drama in Jackson Hole. Forget about it. You're in there. It's a press conference. What's your first question? This is the only place McKee gets a first question. What's your question to Chairman Powell after that speech?
Oh, I think what you would ask him basically is, what is it that is going to determine how long you keep rates up? We know you're going to keep rates up, but is it going to be the move in the real rates, and when would you expect that to happen? Or do you just stay with higher rates until you're maybe below 3% into the twos?
I'm curious about one dimension of this speech. He talked about the need for below-trend growth and easing of the labour market. We don't have below-trend growth. When they talk about being sufficiently restrictive and telling us that they think they are, what evidence do they have for that, Mike?
Well, they don't have it yet, and Powell noted that. He said it looks like growth is faster than anticipated, and certainly the preliminary numbers for the third quarter are telling us that. And I think that feeds back into his assertion that we are not done and we will do what's necessary, because he made a tie between the idea that the economy is moving at a faster pace and the labor market, and the fact that we could see inflation develop out of that, which is something that some of the other more hawkish members of the committee have suggested, that the growth rate is something that concerns them. So he tied those two together and leaves the possibility of higher rates maybe even a little bit closer than they were yesterday.
Mike, stay close. You're going to stick around?
Yeah.
Patrick Harker coming up a little bit later. The first reaction from inside the Federal Reserve right here in Jackson Hole, Wyoming. That interview coming up in about 30 minutes from now. The perfect guest for reaction to this speech is Mohammed Al-Aaron of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, thanks for being with us and being with us through that speech as well. What were your thoughts when you heard some of those words from Chairman Powell just moments ago?
I had three takeaways, John. First, it's a speech that said very little that is new. He repeated what he has said in the past, and he has retained maximum policy optionality. Second, he reminded us that with the exception of the inflation target, which he said is 2% and will remain 2%, everything else is uncertain. And his reference to our star in particular was very interesting. And third, what I thought was also curious is how he ended the speech. He ended his speech talking about we will follow the stars in a cloudy sky. Everybody sees the cloudy sky, but what's interesting is that the rest of Jackson Hole will be about moving stars, all the structural changes that are going on domestically and internationally. And that just adds to the topic that the three of you have been talking, that it's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
Mohammed, one conversation you and I have had over the last several weeks, the last several months for that matter, people are having this discussion here as well. Are we, from your standpoint, in your opinion, sufficiently restrictive?
John, this goes immediately to what is the right inflation target. If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive. If the right inflation target, as you've heard many people say, including Adam Posen today, is above 2%, given all the structural changes, and the way we're going to get there is not by announcing the new target, but by following a shadow target, and then once we see it stable, adopting it, I think that's the most likely outcome, by the way, then we are sufficiently restrictive.
Mohammed, does it concern you that we've heard a lot of people who sound pretty happy, actually, other than Jay Powell, who is taking sort of the adult tone of, we're not there yet, stop declaring victory, there's a lot more down the pike. Everybody else sounds like things are going really well and the Fed policy is achieving exactly what it sought to.
So I don't think it's everybody else, but most people are, especially in the marketplace. Not so the economists. You have Larry Summers, for example, reminding us this morning that if you look at the 70s inflation cycle, this one looks very similar. He has the two graphs up, and he's sort of warning implicitly that we may see a pickup in inflation. So I think the marketplace is much more complacent than the economists are. The economists recognize that there are many moving pieces, whereas the marketplace thinks that we've gotten to a new equilibrium, and from here is going to be cuts next year. That remains to be seen.
Do you think, Mohammed, that it's important for the Fed to get ahead of a potential resurgence in inflation, or do you think that Jay Powell's approach of watching the stars and seeing what they are will be sufficient to curtail some sort of more embedded inflation?
It's hard, Lisa, because as you know, they have not, like past Feds, opted for a strategic view of inflation, nor do they have a functional monetary policy framework. So they've become highly data dependent, which means that they are using instruments with lags on backward-looking data. So they are in a bit of a tough situation. They're going to remain data dependent. So I don't think he knows what they will do in September. He's going to wait to see what the jobs report is. He's going to wait for the CPI numbers, and then they're going to decide what to do. But this is the irony, it's a highly dependent, data-dependent Fed using instruments that act with a lag.
On radio and television here from Jackson Hole, Mohammed El-Erian with us this morning. And as Dr. El-Erian speaks, John, markets are moving here. I just noticed the rebound in dollar back above DXY at 104 to Global Wall Street. That's important.
Break of 108 on the euro as well, Tom, against the dollar right now, about 107.95. Equities elevated through that speech, but coming back just in the last 10 or 20 minutes. Yeah. Plenty of feedback, Tom. This coming from Neil Dutta of RenMac, just published in.
Please.
Saying the following. I thought Powell delivered a neutral speech. The Fed sees its monetary policy stance as restrictive and will make a more tempered approach to future meetings. Proceed carefully, risk management. These are all catchphrases for do nothing right now. The view from Neil Dutta just moments ago.
A lot more response coming in here, a mixed market, red and green on the screen. Dr. El-Erian, I want to touch upon your iconic work in game theory. And that what the word that I'm hearing this morning is complexity. I heard it from you. I heard it from John Lipsky and others. The simplicity we're all begging for is T decisions. You are known for this. This is a Jackson Hole devoid of T decisions. How do our viewers and listeners handle the complexity now and to come?
Tom, I think the most important thing to understand is that we have left the world of insufficient demand and we are now in a world of insufficient supply. And there's many reasons for that. It's a world that's not going to go away anytime soon. It's not pandemic issues that are fully reversible quickly. There are longer-term issues going on, changed globalization, supply chain management, the functioning of the labor market, and the list goes on. So we are now in a different world of supply-side constraints. And that world will mean that countries will become more inwardly looking, which we've seen already. And it also means that policy has to adjust to that. Now, put on top of that the layer of industrial policy as we embark more meaningfully on a green transition. And it's all about the supply side, Tom. And that's where monetary policy is really challenged, because it acts on the demand side.
We're thrilled, Mohammed, to have Dr. Georgieva with us, and then you and Christine Lagarde with us later. And the heart of the matter is, are we beyond the supply shocks of this pandemic? Where are we on that continuum, Mohammed? Have we escaped COVID?
I mean, we've escaped the worst of COVID, but we're dealing with the legacy of COVID. But we're also dealing with the legacy of the war. We're also dealing with many other legacies. You know, Tom, it's fascinating that you will have President Lagarde on, because if you think the U.S. is complicated, then in terms of degrees of complexity, Europe is even higher. The UK is even higher than that. So it's going to be really interesting to talk, as you will do, to President Lagarde, because even though she has a single mandate, her environment is significantly more complicated than the Fed's, which is already complicated.
So, Mohammed, she is so much more exposed. Europe is much more exposed to what's developing in China at the moment. Mohammed, if you took the US out of the equation right now, and we were talking just about Europe and China, wouldn't we be talking about things like rate cuts and easing and stimulating the economy?
If you take the U.S. out of the equation, you would be talking about stagflation. And that's what everybody is afraid of. The U.S. is exceptional, and it's exceptional in its economic performance. And if you take the U.S. away, then you're taking away the only engine of growth for this global economy, but you're not taking away the supply side issues that are causing the inflationary pressures. So if you take the U.S. away, we would be talking about not just the risk of stagflation in Europe, but you would be talking about the risk of stagflation in the global economy.
Mohammed, is that the risk or the reality in Europe right now?
John, is still the risk. Yes, Germany is struggling the most, and that is, if you like, the engine for Europe. But there's also good things happening in Europe away from Germany. It's a high risk. It's flashing red, not even yellow. It's flashing red. But it's not yet a done deal. The U.S. is much better off. China, ironically, is the one that's suffering the most. As you've been discussing all morning, there is no obvious policy response. And now these piecemeal responses are being rejected by the marketplace really quickly. The marketplace is no longer embracing the notion that China can get itself out of the mess it finds itself in.
And that's perhaps the cause of the manufacturing recession that we see in Germany and parts of Europe. But the services side, we've been talking about how that's maybe more directly affected by the ECB's policies and where rates are and the more direct transmission mechanism than in the U.S. Jay Powell just said that there is evidence that the long and variable lags are coming to the fore and will actually reduce growth materially in the U.S. Is Europe a model for where the U.S. is headed with respect to services in the next couple of months or in the next year?
I hope not, Lisa. Our service sector has been stronger. And even though the PMI numbers this week were disappointing, at least they were over 50 for the service sector. We don't want PMIs south of 50. And also, ironically, the service sector is where Europe gets the stagflation as well. It's not the goods sector, it's the service sector that's the inflation source of an inflation problem. So I hope we don't follow Europe, because if we do, then we will be talking about a very different outlook for the U.S.
We're still talking about the potential for some sort of weakness down the pike. One thing that Jay Powell's speech did was seem to remove rate cuts in the near future, at least for the foreseeable future. And you can see that shifting upward in the rate expectations. Do you think that this economy can handle a 5% Fed funds rate for the remainder of next year, even with all the strength that you're hearing about?
Lisa, we don't know. And he did use the word agile, and that's absolutely correct. he's got to be agile. Look, there are all sorts of sectors that adjust with a lag. We haven't seen the full impact yet of the higher rates. You're starting to see it play out in various segments, but in a very small way. Remember, not everything gets refinanced immediately. This is very unlike the UK economy, where the effective duration is much shorter. So you get refinancing quickly, and the rate effects happen much quicker. So we don't know how well we can navigate the 5%. It seems that the big issues in the banking sector are behind us. But so far, and it's really important to stress this, we've dealt only with interest rate risk. We have not dealt with credit risk. We have not dealt with liquidity risk. And that's what people in the marketplace have to keep an eye on.
Mohammed, stay close. Just want to go through what we've heard in the last 30 minutes from Chairman Powell. The 2% inflation target is and will remain our inflation target. We'll keep at it until the job is done. A far more nuanced speech from the Fed chairman this time around compared to, say, 12 months ago. Plenty of feedback on the Bloomberg terminal. Thank you for that. Keep it coming. This from one subscriber this morning saying back in 2022, this was the quote, "We're taking forceful and rapid steps." 2023, the quote this time around, "We are in a position to proceed carefully." It's a very, very different tone, to borrow Lisa's language, in the last few moments compared to, say, a year ago. So let's take a look at the price action from where we've been from this morning through that speech and out the other side. Your equity market shaping up as follows on the S&P 500. Equities right now just about unchanged. Equities going absolutely nowhere. In the bond market, yields up, Lisa, by 3 basis points to 426.90.
And that's on the 10-year. On the 2-year, you're looking at a new high of 5.08%, which is interesting and speaks to this potential for another rate rise, but even more, no rate cuts in the foreseeable future, and that's something that's new.
Stuart Kaiser of Citi, publishing just moments ago, give you a flavour of what's happening on the south side. Not a game changer for markets from Chair Powell, but reminders on upside risk to inflation that demand downside risks to growth. Mohammed Al-Arian still with us. Mohammed, I just want to finish on that with you. The downside risk to growth to counter the upside risk to inflation. Is that something we all need to be cautious of going into year end and beyond?
Yes, and that's why Chair Powell had a speech full of optionality. You know, I go back to what Mike McKee correctly said. It's not that the content was new. It wasn't. There was nothing in that speech that we didn't know before, whether it was explaining what has been behind inflation or whether it was explaining the range of policy possibilities and the risks and the need for risk management. All that has been said before. What was notable this time is that it was packaged slightly more hawkish than dovish. And that's what people are picking up on. But ultimately, John, if we step back, the only thing he said is that what we know for sure is his belief is that 2% is the right inflation target and will remain the right inflation target. That issue is going to be hotly discussed in the next quarters as we get more and more data.
Yeah, Mohammed, I don't think that debate's going away anytime soon, even if Chairman Powell tries to put it to bed. Mohammed, thanks for being with us today. Appreciate it, as always. Mohammed Al-Arian. Let's go through the markets. Equities on one board, bonds on the next. We'll finish on foreign exchange. Starting with stocks. In the last hour or so, the price action shaping up as follows on the S&P 500. And on the Nasdaq, we look a little something like this. Equities on the S&P just about unchanged now, going nowhere. So we fade from where we were at the opening bell. On the Nasdaq, just about unchanged as well. If you switch on the board and get to the bond market, we'll just slice up this yield curve. 2-year, 10-year, 30-year. Cycle high on a 10-year in the last week of 436. Yields were lower initially, now they're higher by 3 basis points on a 10-year, 426.70. That 2-year really close to a cycle high right now of 5.08% and higher, Tom, by 5 basis points on the day.
To cut to the chase, if I'm a CFO of any large cap, mid cap company, I'm looking at that data check and I'm going, how do we adjust to this? Critically off the real rate, which is not through 2%. But I'm sorry, these yields are something where everyone has to adjust.
That 2-year, not necessarily higher, but high for longer. That's what we're starting to think about.
Yeah,
just
the
a little bit
longer,
more.
I agree. The longer.
High for longer. I want to finish on foreign exchange.
Yeah.
Off the back of that, the euro, a break of 108 again. The euro against the dollar looks something like this: 107.84. We're negative 0.2%. If you want to take a look at cable, the pound against the US dollar, 125.74 here, Tom, negative 0.2%.
We're going to continue this discussion and really stay with you for the next number of hours. Moving to Christine Lagarde here, and after her speech here, I should say, at Jackson Hole. Please look for that. But far more, it will be analysis and interpretation. Owning the high ground on that is Joseph Weisenthal and Tracy Alloway. They host a podcast, Odd Lots. Alloway had to redo her fireplace mantle because the awards have come in.
Oh, right.
So
they're
large.
piling up.
Yeah, they're piling up. I mean, my Weisenthal already had a mantle that could hold 300 pounds.
In New York City. Joining
us, Tracy Alloway from Outlets. Weisenthal would not get out of bed this early this morning. What I love about your work back at the FT and years ago is you own a perspective of London and New York in synthesizing the Western world. China and an exceptional Japan with Ueda in attendance here in this YCC disaster just had to listen to his hawkish one. How does Asia interpret what we heard this morning?
Well, I'm kind of confused at some of the bond market action that we've seen. So 2-year yields going above 5%. Hawkish interpretation, but I'm on the Neil Dutta side here, which is this was a very dovish speech, actually. Powell sort of gave a nod to the R-star debate, the idea about whether or not the neutral rate of interest is structurally higher in the current world. But then in the next sentence, he basically goes, but we have no idea what R-star is anyway, so it's completely irrelevant. And they're talking about being at restrictive.
That's not a small matter,
already.
John. Yeah, that's not a small matter. This has come up a couple times today. The guy from New York City, you know, the private equity guy, whatever Powell is, he's not too big on the plugins of R-star.
But Tracy, something you've discussed, this probably shouldn't come as a surprise, should it?
I don't think so. To me, it very much resembles what we saw last month from Powell. It's very much a data-dependent speech, which makes sense because you have two major data points coming up before the next Fed decision. Why would Powell stick his neck out at this particular moment in time? And of course, there is a lot of uncertainty about those long and variable lags, as you were talking about, Lisa.
Well, and this is a problem right now for Jay Powell because he wants to bring things down, but he doesn't want to curtail dynamism too much. Do you think that it seems fair to view his speech as saying that rate cuts are not in the cards for a longer period of time next year? Because that's maybe what he wanted to say in the implicit sort of tone, but not what he actually said.
I think he'd have to see a real deterioration in the underlying data to justify a rate cut, and that's just not happening. We have a lot of sort of anecdotal data points about maybe consumer spending is starting to weaken, but we haven't seen any of that in the unemployment rate, right? Now, that said, I know the tone of this particular Jackson Hole is very different to last year, where Powell was talking about how we'd have to assume more pain in order to bring down inflation. But that said, it's still a really uncomfortable moment for central bankers because inflation is coming down in a way that they didn't necessarily expect, right? The Phillips curve says that if inflation's coming down, the unemployment rate should be going up, but that hasn't been what's happening. So there's still a ton of uncertainty here.
This is essentially, while it is global central bankers coming together, it's also essentially an academic conference. You're here with Odd Lots to speak to some of the academic research. What are you hoping to illuminate in this whole shifting global structure that was sort of the theme?
Yeah, that's exactly right. So I know that the focus is always going to be on the sort of short-term outlook for interest rates, but really Jackson Hole is about the long-term framework of monetary policy. And one of the big themes that is starting to emerge is this idea of higher public debt. And we've seen that borne out in the Fitch rating cut recently, bond yields higher because of some concerns over the outlook for U.S. fiscal health. And again, the unusual thing about this moment in time is that we are seeing massive fiscal spending at a time of low unemployment. That hasn't really happened before. And so I think there are a lot of people at this conference who are wrestling with that idea and that dynamic.
You and Joe Weisenthal have Rockstar Hours. You just sort of wander in and you do your podcast, and you do it by piecing together conversations where Bloomberg Surveillance is complete and total chaos 24/7. What's the conversation here you're most looking for into your next podcast?
Well, thank you for assuming that All Thoughts isn't constant chaos as well, Tom. Well, we're having you on later today.
No, that doesn't count. That was
it
just,
counts.
Well, please. What's the conversation you want right now at Jackson Hole?
Okay, the big picture goes back to that bond outlook. What does a world of structurally higher debt look like? Does it necessitate higher interest rates? And what new financial risks does it introduce into the system? So we basically moved from a system that was very much reliant on bank lending to one that is far more bond-based. And how do you square a world where bonds really, really matter with central bank mandates to bring down inflation? There's a tension there. You can't build the financial system on bonds and assume that they're going to be very low volatility and then try to bring down inflation and have higher rates.
Tracy, this was great. It's good to have you here.
Thank you. Thank you for having me.
Thank you very much. Tracy Alloway, the co-host of the Odd Lots podcast. Let's turn to the price action. I want to bring your attention to the 2-year. If the 2-year closed right here, right now on a closing basis, that would be a new cycle high, 5.09%. Yields are higher at the front end by close to 7 basis points, just short of 5.1%. I believe the cycle high intraday was something like 5.11% earlier on this summer, but we're getting closer off the back of this speech. Not the initial reaction, but it's the reaction in the last 20 minutes or so. The 10-year yield's higher by 4 basis points, 4.28. The cycle high there was a little bit earlier in the past week of about 4.36. Right now, 4.27.89. Just to go back to what Neil Dutta said, described it as neutral, Bramo. Said it was a neutral speech from the chairman. I said don't define that speech by the intraday price action off the back of it. I don't think you should do that now either, but ultimately the early interpretation of what we heard from Chairman Powell in the past hour is high, potentially for a whole lot longer.
And this concept of we are getting back to 2%, the fact that he led and emphasized with that really highlights that he's trying to cast cold water on all those people saying, maybe we just need to fudge a little bit, that everything can be good.
There's 2 events today. Chairman Powell, that event's behind us. The other one is to hear from ECB President Christine Lagarde. So let's put those 2 together in one currency pair, the euro against the dollar. And clearly the dollar is where the strength is right now against the euro, which is weaker. The euro against the dollar at the moment on my screen, 107.76. Tom, that's your break of 108 all over again in the past hour.
You see that with the euro, and then you look at sterling. Remind me where Jordan Rochester was at Nomura. What's he?
Jordan's talking up. He's talking up 122 on sterling, and he's talking up or talking down euro dollar to about 105.
And this is where Jerome Powell becomes central banker to the world. We're not talking about Bailey, central banker to the world, Ueda, even Lagarde. We're talking about Powell having to react to each and every type that's here.
Mohammed was with us 20 minutes ago, Tom, and he was talking about the risk of stagflation in Europe. My question was, is that a risk or reality right now for the Europeans? And I know you'll have that conversation later with President Lagarde.
It's going to be interesting. And the key word I've learned today, folks, for those of you just joining us worldwide, thrilled with the feedback. Thank you so much for your feedback as we really commit to this debate about where are we heading into 2024, or for that matter, 2034. But really the heart of the matter for me is one single word: complexity, and how it redounds onto others as well. So we will take a turn here and look at the central banker of the world and how he affects other nations. Lesetja Kganyago joins us now, governor of the South African Reserve Bank. You know what I did on the Bloomberg, sir. I went to USD ZAR to capture the thermometer of the Powell speech upon EM as well. What are the ramifications if South African Rand breaks through in the coming weeks to new weakness, dare I say, to a 20 level? What is the ramification of weaker currencies right now?
Well, we are a central bank that targets inflation. And the focus is on what that would, if such a weakness does materialize, what it would mean for inflation in South Africa. We have started much earlier to tackle inflation. It has come down significantly. It is now closer to the midpoint of our inflation target range. And on the horizon, we actually see the exchange rate as one of the risks to the inflation outlook. So if there was to be a weakness in the currency, it does have implication for the inflation outlook. Though what we had seen had been that the pass-through effects from the exchange rate to inflation had weakened over the past while.
So on balance, Governor, is this high for longer? Is that the approach of the South African Central Bank? Is it similar to the Federal Reserve and what we heard from Chairman Powell, or is it different?
Well, we are focused on the outlook for the South African economy for both growth and for inflation. The job is not yet done. The decline in inflation is welcome, but we have just had 2 good prints of inflation. That does not mean that the inflation monster had been conquered. There are still risks on the horizon, and we would watch that very closely.
So it took you 30 hours, I believe, to get here. Is that correct?
Yes.
It took you 30 hours and transferring through different places to get to this remote spot.
It took us 30 hours to get from New York.
It's such a remote spot. What were you hoping to hear? Was this speech worth it?
It's always important to hear what the chair of the Fed says, because what the Fed does has got implications for global financial conditions. And as a small, open economy, the effects of U.S. monetary policy have got implications for our outlook. Jackson Hole is always a place to learn. It's not just about the speech of the chair of the Fed. Many of you, I know that is what you watch, but there are very important technical discussions that are going to be taking place over the next 2 days.
There's a bias here, Governor, that I think you can help us blow up. The approach is always, what can you learn from them? What can they learn from you? Emerging market central banks, they are the original front loaders in this cycle. You guys got ahead of this before these guys, before the Federal Reserve. What can they learn from the inflation dynamics that we typically associate with emerging markets? What can they learn from you?
Well, as emerging market central banks, we can tell inflation from a distance. We have, unlike the advanced economies which had experienced close to zero inflation, we had always lived with inflation for some time. And I think that the important lesson just for all the central banks is that complacency could become the enemy, and secondly, that the decisions that we have to take are very complex, but that you can't wait until you have got all the data before you act. By that time, it would be too late. So a risk-based approach is the correct posture to
So
take.
do you think that on the margins, this Federal Reserve is complacent or too complacent to track the data and to be data dependent in a way that's backward looking and not getting ahead of inflation that can get out in front of them?
Central banking and monetary policy decisions are very complex. And I have got no doubt that the decisions that the Fed takes, they take them on the best information that they have. And this is central banking, and you make decisions, and economic history always judges you. So I will leave it there.
Something that has happened in the news, which is agreements of China and your South Africa building technology utilities in South Africa brick by brick. Help us understand what South Africa just signed on an economic basis with China.
I have not been privy to those kinds of agreements. What I can tell you is that we, as central banks in the BRIC community, we have been in conversations with each other, and our focus had been really on the business of central banking. It had been a focus on putting in place safety nets, and secondly, making sure that our payment systems are interoperable and that it could facilitate trade. That is what central banks have been focused on.
Governor, I've known you a long time. You've been a good friend over the years. Thanks for being with us. Appreciate it. It's good to see you here in Jackson Hole. Thank you, sir.
Much appreciated.
Governor Lesetja Kganyago there of the South African Central Bank. A couple of headlines I want to draw your attention to. Might be a wrinkle in the outlook for this Federal Reserve, by the way, as well. This from the auto workers, authorising the union to strike if contract talks fail. UAW members clearing the path for an auto worker strike as soon as September 15th, so potentially the middle of September. We talked about this a lot over the last couple of weeks. We had a deal with UPS, higher wages. We've had a deal with the pilots over at American Airlines, higher wages. And Lisa, one thing you said we haven't had are the strikes that go with some of this labour power. You wonder if that changes over the next couple of weeks.
And what they have to get if it doesn't change, right? In other words, what kind of concessions do they get from the auto manufacturers that they've said what will amount to about $1 billion in extra costs every year?
These are market moves in the last 10 minutes, and I'm going to suggest, folks, may be wrong in this, we're a bit abandoned out here, but this recent move, John, is off this auto worker news. Equities, soggy, yields moving up. We're starting to talk about 2008 levels, dollar dynamics as well. There's more going on than just Jackson Hole.
Does this complicate the effort of this Fed chair, of this Federal Reserve?
Yes, because there's something in the air. Far more important about this is that John may be leaving. I don't know if you know this, folks. John may be leaving us here in the coming weeks for UPS training to try to get towards.
Hey, jokes aside.
Can you see him in the brown shorts?
He's going to work for UPS during the day.
I said
for
American
United
Airlines
Auto
on the
Worker,
weekend.
American Airlines on the weekend.
American Airlines is my airline.
Okay, there you go. You'll get status.
Think what Sean in Boston has done with Teamsters and bring that over to UAW.
Yeah.
This is not your mother's UAW. This is not Steve Ratner's UAW. It's got to be a new UAW.
And then I'm going over to the governor, to Joburg, and going to be an intern at the South African Central Bank.
Good.
Next summer.
You're still going to have to get your luggage.
I don't think the Central wants that to happen at all. It's just like, absolutely no thank you. No thank you. Coming up shortly, the Philadelphia Fed President Patrick Harker, the first reaction from inside the Federal Reserve to that speech from Chairman Powell. That's all coming up shortly. Your equity market right now, negative on the S&P 500. In the bond market, yields higher by 6 basis points on a 2-year, on a 10-year here, up by 3 basis points. It's yields up, dollar stronger, stocks down. This is Bloomberg.
It is the Fed's job to bring inflation down to our 2% goal, and we will do so.
People say you can't raise it now, but my worry is the opposite, which is you say 2 means 2, but it's going to be another 2 years before we get to 2.
They have to have a credible strategy for getting to 2%.
It's way too early to declare victory.
It's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We will keep at it until the job is done. The message from the Federal Reserve Chairman in the last hour, live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Alongside us now is Bloomberg's Mike McKee. And Mike, I don't think we should waste any time. Joining us is Patrick Harker, the Philadelphia Fed President. Patrick, good morning.
Good morning.
Let's start right here. Not what Chairman Powell said, but what your colleague over at the Boston Fed said in the last 24 hours, that this resilience to this economy suggests maybe we might have to do more. You take a different view. Why?
So look, we have to get inflation down to 2%. We all agree on that. I mean, we're all committed to that. The question is how to get there. We are at a restrictive stance, in my view, and we're putting pressure on the economy to slow inflation. The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through. Again, the data may dictate that we change course, or I change course. But for right now, what I'm seeing and what I'm hearing, particularly soft data, what I'm hearing, I've been around my district all summer talking to people, is that the plea I hear is you've done a lot very quickly, right? You've taken a lot of pressure quickly. Now let us work through that. Let the banking system work through it. Let the corporations work through that. So that, I agree with that. I think we just keep the pressure on and see how things turn out.
Jay Powell didn't really say anything new, but he did sort of cast it in a hawkish light. And he talked about how the economy is perhaps growing faster than anticipated, and that could increase inflationary pressures. So what would it take to get you to change your view and think we need to raise rates more?
If we saw that the decreases in inflation were stalling, right, that we weren't making that progress that we need to make.
But how would that manifest itself? Because the people who calculate CPI, the analysts, suggest we're going to see it go back up just essentially for mechanical reasons.
On the headline side, for sure. But we're going to see shelter inflation come down, right? That it's coming down now. You see this with real-time rents. So if service inflation in particular, or core service inflation, whatever you want to call it, super core, if that continues to stall, then I'd say we have to do more. But again, I really want to emphasize, we are doing something right now. It's not as though keeping rates where they are is doing nothing. We're actually continuing to put pressure on the economy.
You said, and Jay Powell just said, that it was important to get inflation back down to 2%. That was unequivocal.
Correct.
Does it matter when? I mean, we're right now can see in the dots that it's not until after 2025.
Yeah.
If it takes till 2030, does it matter?
Oh, yeah, 2030 is a long way off. Yeah,
2026, 2027, and when's this sort of
we're going to get
sense?
under 4 this year, under 3 next year, and then get to 2 in 2025. So, yeah, it's going to take some time. But what really matters, what I hear all the time is not just a headline, not just super core, but think about the essentials of life, the things that people really need: shelter, food, transportation, energy. As long as they're moving in the right direction, Americans are better off, and we need to be committed to that.
You clearly think we're sufficiently restrictive. Other people think we don't. So let's go through their points. Unemployment still 3.5%. Growth this quarter could come in at about 3%.
Yep.
What is the evidence that we're sufficiently restrictive? What can you actually point to beyond the soft data? Let's talk about the real hard data.
So inflation is starting to soften. We are hearing story after story. I'm hearing of.
And you think that's connected to where interest rates are right now?
Yeah,
What's the channel for that?
Labor markets are definitely easing up. We're hearing this over and over again. It's easier to get employees. And the retail numbers I'm a little suspicious of, because what we're hearing, for example, from a major supplier to the back-to-school market is sales are not what they expected. So we are starting to see these early signs, but they're early, right? And so I don't think we need to react either way right now. Just let this ride a little bit. Let's just keep putting the pressure on.
Well, if you keep the pressure on, but even don't raise rates, how long do you need to keep the pressure on? When would you see moving away from the peak?
Clearly not until next year at the earliest. And when next year, again, the data will have to dictate that.
Well, there is a question about if inflation keeps coming down, real rates continue to rise and put additional pressure on the economy. Would you see the Fed recalibrate its peak rate to keep the pressure steady as opposed to letting it grow? I realize this is a fine point for the markets, and if you if you say this the wrong way, they're all going to start pricing in rate cuts.
Look, it's possible, right? But at this point, we really need to see inflation moving down. And we're seeing early signs of that, again, and I'm getting story after story from all our contacts that it is starting to happen. But I want to keep rates where they are right now, and then we'll decide later what we do.
What do you think is happening with labor market wages at this point? Because that was the big concern, especially with Jay Powell's non-housing services. These guys were talking about the United Auto Workers negotiations going on. Have we broken the back of rising wages rising at a too fast a pace?
Too early to tell right now, but it does seem like what I'm hearing from all our contacts is that it is starting to ease, right? I mean, we're not where we were, where mid-year increases are there. Nobody's considering that. So we are starting to see some easing, particularly in the service area, hotels, restaurants, and so forth. We are starting to see it getting a little easier to get the table at the restaurant. And one of the things that I think about, one of the potential risks is that when student loan payments come back in, I don't think it's a big economic issue. I mean, when you run the numbers, it's not, but it's a psychological issue. Here, I've not gotten that $300, $400, $500 bill. Now I get it. And so I've been talking to a lot of people of that generation who are saying, yeah, I may have to back off some of my spending.
Well, but this goes to this question of, okay, well, the savings are going to get borne down, and then we're going to start to see the real economy expose itself, right? A lot of people have questioned that. But I am wondering what kind of neutral rate, what kind of, sort of longer term expectation for the Fed do you expect in the new normal? What does it look like?
Yeah, so we don't know for sure, right? Let's start there. We don't know exactly what that new normal looks like. But one of the things I think about is what's fundamentally shifted in the economy between before the pandemic and now. Remember before the pandemic, hard to remember for all of us, right? Given what we've been through. But we had low interest rates, low unemployment, and low inflation. What's fundamentally shifted? There have been a lot of things. We're going to talk about this in this meeting. There's supply chain issues that are shifting and being re-engineered. But fundamentally, I think it's plausible that we can get back to that. No, I'm not predicting that right now, but it is plausible. So I think we have to realize that we lived in that world. We've proven that that can happen. And so could it happen again? Yes.
Sounds like a base case when I listen to you. Is that your base case?
I don't know. I mean, at this point, I'm not quite sure. But clearly, we think we'll get back to trend growth in a couple of years. We'll get inflation under control in a couple of years. And inflation and unemployment will tick up, but really in the 4-ish range, back to the neutral rate.
You've offered example after example in the last 8 minutes. It's highly anecdotal. Is the beige book now more important to us than US retail sales?
When I step back and I think about myself, and I can only speak for myself, right? When we were going through the early part of the pandemic, and we were saying that inflation was transitory, it was just used vehicles and so forth. What I was hearing from my contacts was now really it's more persistent. And I didn't factor that in. The mistake I made, if I made a mistake, was I didn't factor that really soft data, that anecdotal data. But it's more than anecdotal data. It's what people are really feeling real time in the economy. Now, we've done a lot of things, like done real-time pulse surveys and so forth to get ahead of that now. I don't want to make that same mistake twice. And so what I'm hearing right now from those same contacts is things seem to be slowing more than the data is showing. That could be wrong. That's why we have to, as Chair Powell said, risk management is an important issue here. But if they're right, if that soft data is right, then I think it really then just solidifies my view that we stay putting pressure on, not necessarily increasing right now, to see how that all resolves itself.
Nerd question for our friends on the trading desks out there, especially the bond guys. The balance sheet has been coming down, but very slowly because of the caps and the way that works. You haven't hit maximum reduction yet on a month-by-month basis. And at the same time, we have seen financial conditions remain easier than you would expect. So the question is, do you do more with the balance sheet because it has an effect on how tight the policy is?
At this point, I don't see us changing course on how we're reducing the balance sheet. Again, circumstances could dictate something else. But for right now, I think we just stay the course, keep that on, as I've said many times before, on autopilot, just let it run. And if we need to adjust policy, we adjust that with the Fed funds rate.
Well, there has been a question on the other side of how close you are to stopping balance sheet reduction when you reach the level of demand.
Yeah, we don't know. I don't think we're there yet, but we do clearly have to monitor that. If you go back to the last time we did this, we knew we were at that point where we needed to stop when we saw the market indicators, the volatility in the market. We've not seen that yet, but we could.
We have seen real yields climb significantly. Today, 5-year real yields, inflation for adjusted yields, rose to the highest levels going back to 2008. Are you watching that closely as an indication of the transmission mechanism of the balance sheet runoff?
Sure. Yeah, I mean, that's one of many. And it's also just simple trading and things like the Fed funds market and so forth. Not at this point. I mean, but it is clearly something we need to keep watching.
Can I finish on this? Slightly provocative. Have you destroyed the mortgage market in America for a generation?
I don't think so. I mean,
why not?
Well, it is clearly tough when you talk to bankers.
Beyond tough. People are locked into mortgages at two handles for the rest of their lives.
First-time home buyer, really, really hard because there's no inventory. Right? Even if they could afford the mortgage, they can't find a home because people are locked into that low mortgage rate, in their existing home. That's why I think we don't keep going with rates, right? It's that we can stay steady, and at some point, as we reduce rates, we can bring those mortgage rates back down. There's no question that's an issue.
But we're not going back to 2% mortgages over 30 years, are we?
Yeah.
So that inventory's offline, maybe for a generation.
Less.
You're not there yet?
Yeah, because what we're hearing from some of the home builders is they keep selling houses.
Oh, they're having a great time.
Yeah.
Stock's having a great time. Right, you've done that a huge favour. I'm talking about whether this housing market can really recover in the next several years, given that this feels quite generational. This feels like a really
but there's a lot of
time.
inventory coming online. I can tell you in Philadelphia and across many cities I know, but Philadelphia, for example, a lot of multifamily is coming online in the next few years. So we are increasing inventory.
Patrick, It's good to see you, as always. Thank you, sir. Patrick Harker, the Philadelphia Fed president. The first reaction there from inside the Federal Reserve following that speech from Chairman Powell in the last hour. Mike McKee, there's an individual that thinks we could just wait here, just keep the pressure on. But keeping the pressure on does not mean increasing interest rates any more than we already have.
Well, you asked me earlier whether the chairman was appealing to one side or the other, and I said in the middle. And at least we've heard from one side here that he doesn't think that Jay Powell is challenging him or making any case against what he's saying.
His point about the soft data is important, I think. And I think especially because anecdotally when I speak to small business owners who are my friends, they talk about how their lifeline is getting a lot shorter in terms of their flexibility and things that they used to be able to do with financing, they no longer can afford to do, especially with some of the other pressures.
So Mohammed Al-Arian, who got the inflation call right, I remember saying to him, what guided you? And what guided him is exactly what Patrick Harker just talked about. It was the responses from companies at the time who were saying, you need to take this more seriously. The conversation continues. Your equity market trying to recover, just about unchanged on the S&P.
After decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
The chairman of the Federal Reserve System, Jerome Powell, this happens once every year, 40 years or more, at the meeting of the Kansas City Fed at Jackson Hole, Wyoming. We welcome all of you this morning. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, truly worldwide today. Thank you so much for the comments. And what an interesting moment. I was off set here with Mr. Harker with you. Lisa, this, more than any year I've been here, has been the most surprising year. And I can't believe I'm saying that after 08, 09, Lehman Brothers and all that.
It's a highly complicated moment for central banking and for fiscal and monetary policy making. And we're seeing all of these different economists and policymakers try to calibrate and not err on the wrong sides. You can feel like we're on a precipice of not knowing the other side, and everyone's grappling with how to really weigh in best.
The people are off camera. They're all waiting to meet you. I happened to stumble on one person who I was, and he was a doctor, and he's treating COVID. And we talked about the new discussions of COVID, and some of it's in the zeitgeist. Talked about the booster to come this fall. But I am adamant that COVID, the pandemic, still touches all that we're doing.
There's something that came clear after Patrick Harker speaking with us, the Philadelphia Fed president, which is the soft data, the conversations that people are having are less positive than the conversations that people may be having here economically about what the numbers are saying. And one key question is, what kind of ammunition do governments have to support an economy that does go into a downturn, given how much debt and given real yields? It's a hard time to see how they're going to come down to such a significant degree.
It's a 5% Atlanta GDP now Fed.
5.9%.
Discuss. Oh, sorry. I didn't get the decimal. We don't do decimal points at Jackson Hole. Okay,
it's almost 6%.
But come on, it's a 6% GDP economy. That's not a slowdown. I mean, it's just...
It's a reacceleration, which is causing a lot of angst for a lot of people.
Okay, we're going to continue forward here. We've got a lot coming up. Justin Wolfers will join us here in a bit. I believe he has a shingle from Michigan. We had to do better than that. The Kellogg School of Management right now. Janice Eberly joins us, professor of finance at Kellogg, and of course a former assistant secretary for economic policy at Treasury as well. Thank you so much. I flew in through O'Hare, and you go over the firmament of Northwestern, and to all of us of a certain vintage, and you've had the great honor of all the academics at Northwestern, of Robert Gordon and his ancient, iconic work on the growth of this nation and his doubt in recent decades over our sustained growth. Take the Gordon Northwestern view into all the policy work you've done about a confidence in American economic growth.
Well, Bob, of course, is iconic, and thank you for inviting me back here today. It's great to be with you. Bob Gordon is one of the stalwarts of Northwestern and the economics community more broadly. And he had a long set of papers questioning what the future of productivity growth would be like, that we'd had this boom, and we've seen a little bit of it in the papers already this morning, and what comes next. Though I will point out that a year ago, Bob had some work that showed some optimism, uncharacteristically, about productivity growth that was coming out of COVID.
Bring it into what you do. What you're famous for is how do we solve fractured policy? We can all agree that we have fractured policy in America right now. How do we coalesce our policy to get to a better growth, a better productivity?
Well, in the debate that we saw reflected a bit in the chair's remarks this morning, as Lisa was saying, it's a very complicated moment. And as the Fed is looking forward to what happens next, you see, a clear focus on the target, but also a little more of risk balancing than we saw, last year in particular, and a more nuanced message that reflects that at a 5% interest rate or higher, raising interest rates further is different than raising interest rates when they first got started. And that balance of risk, I think, reflects some of the complications that you were talking about.
There's also an issue and a complication here of what the potential casualty could be about going into a downturn, given the lack of potential fiscal stimulus that could really get pumped into a system given the debt load and given how high financing costs are. How much does that create a more difficult scenario next time this nation, among many others, goes into recession?
So that's the short run. It creates a more difficult calculus for the Fed immediately because the increase in interest rates has more of an impact when the economy is weakening, when balance sheets are wavering more than they have in the past. So part of the reason we've had this surprising strength now is that we came into COVID with a pretty strong economy, and so it had less of an impact. But going forward, we can't count on that, and so the Fed's complicated decision-making reflects hard decision-making for families, for businesses, and the choices that are being made throughout the economy.
We were just talking about the mortgage market and how everybody locked in their 30-year. Everyone who got smart and got ahead of this. The U.S. government did not do that. They did not lock in the longer term, low-yielding debt. Is that a big problem? Why didn't they? Why didn't the U.S. sell more debt that was 30 years long and had a 2% coupon?
It's a combination of the Treasury and the Fed. I mean, the Treasury always has discussions about the maturity structure of the debt. And during a crisis, they're especially focused on providing liquidity. And that means going in and providing shorter run securities rather than longer run securities. So U.S. government debt tends to have a shorter maturity structure, partially because of its special role in the global economy. But there's clearly an awareness that there's a cost to that of not locking in the longer run rates.
One of the key things we know is Northwestern is closer to Wrigley Field than Chicago. I want to dovetail what Krosner's doing down at Chicago with what you're doing up at Northwestern. You and Randy Krosner are hardwired to pay attention to American business. How does American business react not only to the yield, but just the Newtonian calculus of a moonshot in T-bill, a moonshot in 2-year yield? Some would dare say a moonshot right now in the real yield.
So you're seeing already a market response to rising issuance, and that's really gotten people's attention because we haven't seen that kind of response certainly in the data that we've seen in our professional lives. And so that gives pause, and especially for businesses because their costs of capital are a premium on what looks to be or is close to a risk-free security. So it makes investment more costly, it makes debt coverage, debt service more costly for businesses. So that's going to lead them to pull back. And Incidentally, that also can make the Fed's inflation fight harder because, ironically, the higher interest rates also, if they lower investment, say in lower residential construction, also put upward pressure on inflation. So that's part of the reason that the calculus is so hard now, because there's these counter flows and not just, the march up higher rates to try to fight inflation.
Professor, thank you so much. Greatly,
My pleasure.
Our pleasure
Thank
to have you today. Janice Everly of Northwestern and Kellogg School of Management. Lisa, very quickly here, bonds, it's all anybody's talking about. These yields extraordinary.
Especially real yields. When you take out inflation, what you're looking at is new highs in this cycle, and that raises some questions about how restrictive that's going to be for the economy.
Giving you expertise on monetary policy here at Jackson Hole, Julia Coronado will join us, some macro policy perspectives. Stay with us worldwide at Jackson Hole. This is Bloomberg Surveillance.
Let's go straight into the price action this Friday morning. Going into the weekend, your equity market shaping up as follows on the S&P 500. On the NASDAQ, equities just about positive. We have been all over the place in the last 60 minutes or so. Call it the last 90 minutes. The S&P just about positive. The NASDAQ joining the party, heading towards a first week of gains for a while for the NASDAQ 100. Into the bond market following Jay Powell, the chairman of the Federal Reserve, speaking in the last 90 minutes, Tom, talking up the potential to do more, but also the job is not done, and we're committed to a 2% inflation target. Your two-year yield higher by 4 basis points to 5.0671% on a 2-year.
To Redux, 20 minutes ago, or was it 27 minutes ago, we did an overlay of wages UAW. I wonder if UAW has a little bit of dynamics going on here besides Jay Powell.
The potential for a strike, Tom, is a wrinkle in the story, that's for sure.
Yeah.
That's for sure. Lisa, we'll go back to a conversation we've had a few times. We've had the pay rises. We've had the union action. We haven't had the strikes.
Exactly.
And I don't think anyone wants to see those strikes anytime soon either.
Which has transmitted into this belief that labor has the upper hand. And that if labor has the upper hand, price increases can continue not just at union jobs, but more broadly. And that is the key question here. Is that going to continue so that you see a longer and higher inflation and a stronger and better economy for even with the rates that we see right now?
So it's time for the surveillance extrapolation. We do this every year at Jackson Hole. John, I'm trying to envision you, brown shorts, working your butt off at UPS, popping 170 all in.
That's so never going to happen, just to be very clear.
Why not? Why are you talking down the potential for this to happen?
If we put John...
Even our next guest is laughing.
Exactly.
Okay. Yes,
John,
exactly.
Lisa, if we put John at Flint, Michigan, building Buicks, what are you going to pop, 225?
Not sure.
You got to pay an auto worker more than a guy delivering boxes.
I want to see this guy wearing those brown shorts, and then we can have that discussion.
I'm not a shorts kind of guy. I think you know where I stand on shorts.
I know,
shorts
that's
are for the
why I'm
beach.
saying that.
This is serious stuff. This wage thing. Are we? Maybe it's a question for Lagarde. Are we going to come back to a more unionized European labor system? I don't believe it, but it's.
If we did, and I know we've discussed this a few times, but while we're here and the conversation has come up, if we had the same level of union membership we did back in the 1970s,
totally
can you imagine the pass-through into wages that we would have experienced?
Huge. 30 seconds before we get to our wonderful guest. My word for Jackson Hole, complexity. I did not think I would say that 2 days ago. That's the zeitgeist this morning. The complexity.
The speech I'm interested in, Chairman Powell, without a doubt, is the biggest speech for global markets. There's no dispute about that. But the speech I'm interested in is the one from Lagarde a little bit later.
I agree.
It's such a tough spot for the Europeans at the moment, looking at how the data's coming in. Inflation's still elevated. And over there at the ECB, you've got a single mandate central bank with a lot of pressure coming from various parts of Europe. And what's been interesting for me is listening to some of the more hawkish central bankers not sound hawkish at all over in Europe. When you listen to people from the Bundesbank, yes, they're committed to getting to 2%. We know that. But are we hearing things like we need to go another 25, another 50? That conversation's changed.
We're going to change the conversation right now as we shift from a discussion of Jerome Powell in the U.S. Fed to Bloomberg's coverage of Christine Lagarde. John, the speech here coming up in an hour, so I lose the time zones. But
Abramowicz got it all written down.
We got the Lagarde speech soon, the Lagarde Q&A, and then we'll have our Bloomberg discussion with Christine Lagarde.
You're going to talk with her at
I don't know when. My people know when. I don't know when.
4 p.m.
But the answer is, we're going to, right now, for this half hour, you need to stay with us. Coming up, Justin Wolfers will be with us from Michigan, and joining us from basically Texas with macro policy perspectives, Julia Coronado, who thinks we're going to talk Fed, but Dr. Coronado, we're going to shift this right forward to ECB.
Okay.
How much worser is it for Lagarde that makes her speech more important than what we heard from
It's
Chairman
a much
Powell?
tougher spot, as you just outlined. I mean, with the U.S., we have the beautiful combination of lower than expected inflation and better than expected economic growth. And Powell can just say, we're going to be patient and watch the data and do what we need to do. Lagarde has a tougher line to walk. You know, the data are weakening in a pretty alarming way, and inflation is yet still elevated. So how do you factor in lags? And the nuances and the risks.
I'm going to interrupt right now because, John, it is a moment here at Jackson Hole, which is of importance when the lead central bankers come out to gaze at the Bloomberg Surveillance set and to take a walk to look at the mountains. John, why don't you identify the victims?
Well, let's go through this piece by piece, Tom. Chairman Powell, Governor Ueda, and President Lagarde. The United States, Japan, and Europe. And, Tom, I think we can say 3 central bankers facing 3 very different issues. Julia Coronado just went through the United States. At the moment, Chairman Powell arguably in the better position of the 3. Robust growth, inflation, they're making progress, there's still work to do. Governor Ueda at the moment, Tom, inflation, arguably what they've been looking for the last several decades, and viewed as a once-in-a-generation opportunity to reset inflation expectations higher in Japan. And then you've got President Lagarde somewhere in between, where inflation is above target and growth is a problem. 3 central bankers, 3 different issues.
The symbolism of this post-pandemic is, I can state clearly, I have never seen this. We go back to Volcker in the 80s. I can't talk about those years, but for our American audience, this is a different central banker at the Bank of Japan. Mr. Ueda, very much American educated, wonderful command of English. He joins these central bankers, including Governor Bailey, with a real grasp of the linkages of Japan, Lisa, to the Western banks.
What this highlights to me is how everyone's grappling with the same mystery from very different vantage points and how interconnected the systems are. The idea of yields in the U.S. and the long end rising, some people say that Governor Ueda has more responsibility to do with that than Chair Powell. There is a question around how much they talk about this interconnectedness as they craft their policies.
There's nothing synchronized about this global economy right now, Tom. There's nothing synchronized about it. If we'd had this meeting between these 3 individuals a year or so ago, we'd maybe say that President Lagarde and Chairman Powell has a lot in common. They've got some work to do. Let's get inflation down. If we were coming out of the pandemic, I think we'd all sit around a table and say, we're on the same page, we're all working in the same direction. Are those 3 working in the same direction now?
No, I think there's completely 3 different subsets. And literally, ECB US, I would say there isn't a direction here as well. Justin Wolfers there shaking the hand of the chairman of the Federal Reserve. Mr. Wolfers will join us here in a moment so we can touch his hand as he is shaking the hand of Jerome Powell. Gazing at all this, including taking fan photos and selfies. Julia Coronado.
I can't help it.
This is not in the textbooks you studied in Texas. None of this.
No.
Just for our American audience, give us the foolishness in the textbooks of YCC in Japan.
Oof, the YCC is a tough one, and I think what we're seeing with Governor Ueda is the difficulty in the transition. That's always been the challenge with YCC, right? How do you get out of it once you've gotten into it? It's bound to be difficult and nonlinear. I think actually that they've managed pretty well so far, and that, yes, as Lisa outlined, it definitely has had a spillover to the U.S., undeniably, right? I mean, we are all interconnected, and that has been part of the rise in long-term yields. And that may be a reality that we are facing with it. So maybe, Japan had been so entrenched dovish and bucking the global trend of inflation fighting. Now they're not. Now they're moving, and so that actually could make Powell and Lagarde's job easier. right? You know, you've got higher yields. We've seen it in mortgage applications response. You know, you're going to see it in auto lending and all kinds of credit channel effects from these higher yields. So maybe, you know, maybe that patient approach means that we will see that housing market turn back down and Powell, you know, the Fed being able to remain on hold if these yields stay at these levels.
Europe, Julia, has been a fascinating case study when it comes to monetary policy. They've made the transmission away from all of that QE. I honestly thought that when President Lagarde backed away from some of that we might have problems on the periphery that didn't really materialize in Italy, Spain, Greece, and elsewhere. There's another really interesting case study that's developed this year. Germany.
Yeah.
Arguably going into recession, but still with an inflation problem.
Yeah.
What do you think we can learn from that?
Yeah, well, I think that one thing we're seeing is very different productivity dynamics, right? I think the U.S. we're starting to see a real dividend post-pandemic as the sand in the gears clears, and we're really seeing, you know, I mean, if we are seeing labor demand, hiring, cooling, and GDP tracking well above trend, that adds up to a whole lot of a productivity boost. Could be temporary, but we're not seeing that in Europe in the same way. So, you know, the U.S. does tend to be a more flexible, dynamic economy in that sense. Maybe we're just getting more of a dividend on that front.
Do you think the United States is an island in that respect, given what's happening everywhere else?
I'm very reluctant about the decoupling notion, right? We are all ultimately intertwined, and our markets and our capital flows are all, we're all tied up together. So, you know, hopefully Europe will catch up to us, not the other way around.
There is a concern about the soft data showing a very different story than the hard data. We heard that from Patrick Harker saying that the soft data suggests weakness that the hard data isn't reflecting. Is the hard data getting less and less accurate, regardless of the reasons why, of its response rate, of whether it's just, you know, in terms of how it's calculated?
There are huge challenges with all the data. You know, the response rates that you touch on have been an issue before the pandemic. That's even worse now. So I think it really does highlight the need to triangulate across all the data sources, the high frequency, the surveys, the hard data. The other mantra that I learned at the Fed was, who knows what GDP is in real time? Follow the labor market. We have so many good, solid labor market metrics. You look at hiring, it's still solid, but it's slowing. Aggregate hours worked are slowing. He touched on that. Labor supply is improving. We've seen a bit better, you know, that kind of cooling off dynamic in the labor market data that isn't showing up in Q3 GDP. So again, that sort of favors that. Let's gather some more data, take some more time, look over a broader sweep of information.
Have we rejected the idea that being late is problematic? If we are late with raising rates sufficiently to curtail inflation, are we now rejecting the idea of embedded inflation expectations?
In terms of the fact that they were late, is that what you're asking?
In fact, the fact that they feel the confidence to be patient and that inflation won't become unmoored.
Right, yes. I think that they demonstrated last year was the year of regaining credibility, which they did by going very aggressively and sometimes surprisingly aggressively and showing, you know, last year at Jackson Hole, and he touched at this at the beginning of his speech, he had to sort of smack the bond market upside the head and say, no, we really mean it. And it worked. And now the bond market's like fully buying into the Fed's higher for longer messaging. So he doesn't need to do that anymore. And you know, again, if that turns around or if he sees that there are worrying signs of easing financial conditions, he can always readjust the message. But right now it's just sort of hold the line. Yes, higher for longer. We think that's what it's going to take. I found it very interesting for him to describe the risks as a little bit of doing too much versus doing too little. He didn't say balanced, but he kind of put them side by side, you know? Like we don't really want to crush the U.S. and global economies. We want to, you know, do this as well as we can, thread this needle as well as we can.
That's a change from last year.
Yeah, a big change from last year.
If you ask them what's the biggest risk, doing too little, doing too much, I think we know the answer.
Yeah.
If that's become more balanced, here's my question to you. Do you believe 2's the goal? Do you believe 2% is the goal?
I think it's beyond Chair Powell's tenure to answer that question.
So I want your opinion.
Interesting.
Do you believe 2% is the goal?
I think that is absolutely what they're going to keep saying until the next policy review.
That wasn't the question. Do you think it is the goal?
It really depends on the circumstances. Like, let's say we get inflation that stabilizes. I do think we need to get a 2 handle. Let me put it that way.
Right.
And if we are stabilized around 2.5% and the economy's humming along, are you really going to break it?
Steve, come on out and bring me my Tang out here as well. I got one more question for Dr. Coronado. Let's cut to the chase. You're widely vetted with your academics as a potential governor of the Federal Reserve System. Would you like to see more dissent, Dr. Coronado, in this job interview at the Fed?
So setting all of that aside, I have enjoyed seeing a little bit more range of views. I think that's good and healthy, and I'm looking forward to seeing more of that. You know, you've got President Bostic coming out a little bit more, laying down the dovish line. Everything is relative. Nothing is dovish, right? It's higher for longer or even higher for even longer. But I think a range of views is very healthy. Very, very healthy.
Julia, this was wonderful. The catch up. Thank you. Julia Coronado of Macro Policy Perspective. 2 is kind of the goal. 2 point something, kind of, maybe, perhaps, at some point in the future.
Putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint.
Fed Chair Jay Powell earlier on this morning in Jackson Hole, Wyoming. Live from Jackson Hole. Good morning to you all. The price action shaping up as follows this morning off the back of that speech. The S&P 500, I have to say, all over the place. Negative, then positive, and just about positive now by 0.25%. One move that stuck for about an hour longer was the move in the bond market. Now that fades, Bramo. Your 10-year, 423. Can we look at the short end just quickly? Yeah. Bring up the 2-year, because that came very close to a cycle high following this speech on a 2-year yield. The 2-year right now, 5.056%. TK still elevated this morning, but nowhere near where it was about an hour ago. Yields up there at the front end by 3 basis points.
John, these are the yields of my youth. I mean, I know we're going back to 2008, 2007, blah, blah, blah. We haven't seen this structure. And my number one question throughout the morning, how does corporate America adapt to this? I mean, if you're Apple and like clockwork, you come out with an X billion dollar refi to buy back shares, is Mester and Cook, are they sitting there right now going, maybe not this time?
The good news for them is that they did the adapting in the pandemic when interest rates were so low. They pushed that maturity wall out, and you'll get a lot of people in fixed income that will tell you now that's in 2025. They've done a lot of work, Tom, to make sure those balance sheets are super, super resilient. Then on the mortgage side, we know what's happened on the mortgage side. You've got people out there, Tom, on 30-year mortgages with 2 handles on them who aren't selling. Inventory's not coming back into the market. So what is the pass-through? We talked about this a lot. We know where rates are at 5.5%. The question you've got to ask is, who's paying them?
Lisa, are we popping 8% mortgages? Is that what we need to reframe as we stagger back to New York?
I think the mortgage market clearly is broken. I think that that's what we've learned in terms of the number of people actually taking out mortgages there. Right. The big takeaway that I've heard is who is going to suffer with these higher rates? Maybe some smaller businesses from Patrick Harker. On the peripheries, you're hearing it more and more.
Strongly. I missed the Harker interview. Michael McKee did that, but I strongly take that point of the uniqueness of small business. We began hours ago in the dark, the cold and snow-filled morning of Jackson Hole with a gentleman from the Peterson Institute, Adam Posen. We finished strong with another gentleman, a senior fellow at the Peterson Institute. Justin Wolfers joins us now, professor of public policy and economics at Michigan. And this is finally at Jackson Hole, where we will have an R-Star discussion, because you studied with Blanchard and Alberto Alesina years and years ago. Blanchard has led the charge on trying to figure out where we're heading on R-Star. Take that we're going to return to low R-Star out to the gloom of an unanchored higher R-Star. Where do you see us, not in 1 year, 6 months, in 5 years?
I think it's the right question, Tom, because if you want to think about what really pins down long-term rates, it's not what the Fed's doing day to day, it's doing deviations around R-Star. So then the big question is, what is R star? Well, you could try and look it up on the terminal, but it's not there. And this is
don't tell them.
Yeah, no, this is the difficulty, though, of macroeconomics, that so many of the variables that we think matter aren't observable. With R star, we got a million theories about it, but what we do know, or think we know, is over 4 decades it's declined. So what's your best guess for the next decade? Seems like a pretty good pattern. So Larry Summers has come out and he sort of thinks R star might be higher now. That's part of his campaign to get rates a little bit higher.
Ken Rogoff said the same thing. Where is Justin Wolfers on this?
Mate, I reckon if you don't have a good idea about where something's going in a really solid story, you say things are just going to keep on being the same. And none of the stories I'm hearing seem particularly convincing, other than, I'm a macroeconomist with a view and I get paid to look confident. I don't want to overstate anyone else's confidence.
I've got to dig into that.
All right, mate.
You mentioned Larry Summers.
Yeah.
You think there's a campaign there to get interest rates higher at this Federal Reserve?
Oh, not in the cynical sense. Larry is a profoundly interesting economist, and Larry's a friend of mine too. What I'd say instead is Larry has a restless mind. Larry spent 5 years trying to convince us all that R star was lower. I didn't understand what he was talking about with secular stagnation for the first couple of years. I finally understood it, and at that point he changes his mind. So the argument and the evidence, I think, for his original secular stagnation thesis looks really pretty strong. Then what's the story that says Larry was right 5 years ago, and today's Larry thinks 5 years ago Larry is wrong? I think he got it right a few years ago.
So you think, just in terms of what we're going back to, pre-pandemic, low inflation, low growth, do you think that sticks?
So I'm glad that you put it in the context of the pandemic, because we all like talking about the post-pandemic economy. We all like talking and feeling like we're in a post-pandemic world. But if you start to think hard about like the interactions within the economy, the pandemic continues to exert a really important influence on the economy, and I think in ways that a lot of lay people and a lot of people on Wall Street don't think about. And I think there's an emotional part to that. I want to leave it behind. I want to stop thinking about it, and so I leave it out of my models. But the moment you think about labour supply, think about the return of women to the workforce, work from home, a fundamental transformation in the way we work, all the investments that didn't happen, the shift towards services, like are gyms going to continue to be important in the future? This is going to continue to shape the economy for another 2, 3, 4, 5 years.
Okay. I could dive into that.
But there's a question here.
Wait a minute. Wolfers runs the marathon like he's from Kenya. I mean, he's like completely cut and chiseled and in shape. He's worried about gyms in the future.
You've seen too many photos with my shirt off, Tom, and you should linger a little less.
All right, moving forward, there is a question. If it's going to take 4 or 5 years, does that mean that the prudent strategy for central banks is to sort of be more patient and to sort of let things happen without gunning it too much with rates?
I think it's that you want to be a little less model-driven. You want to be a little less sure of what's going on. I mean, this was obviously true in 2021. If you stood there in 2020 or 2021 and said, this is what my Phillips curve says, in a moment where we were shutting down economies around the world, that, of course, was crazy. Pandemic economies are different than normal economies. Economies recovering from a pandemic are also different in very interesting and important ways. And so that means you're a little less confident about what the model says and a little more looking at what the data says.
And which data are you looking at? Because we heard earlier that the data is flawed, the models are flawed. Do you now just do anecdotes?
Well, the economists are flawed too. But, the only thing that's more flawed is the critics. I've always said the single best defense of economics is that there's no better alternative. We are the least worst alternative you've got out there. So let me give an example of what I mean. Inflation right now is 3% and on the way down. You could look at your model and say, well, with unemployment at 3.5%, inflation's definitely going to be on the way back up. Or you could have a bit of a pause and say, I'm not quite sure the models are operating right now. In which case, I'm not quite sure that inflation's going to shoot back up again. And that's what I mean about being a little bit more driven by the data. Keep your eye on the things you actually care about and less on the intermediate variables that your models tell you should be focusing on.
I think we've all been humbled over the last few years, and I always say, Justin, that I'm in the cheap seats, that to be a critic of what's going on around me, we've all been humbled. by what everyone has got wrong about going into the pandemic, coming out of the pandemic. Do you think that humility that's come about from that is good for the profession, good for economics?
What an utterly charming thought. Yes, humility is wonderful and a wonderful, wonderful strategy for economists. Now, have you met economists?
Many.
It's in very short supply. We get paid to look confident, to beat our chest, to... If I come on your show, and actually I just did, I apologize for this, and you say, hey, what's going to happen? I'm like,
I don't know.
really know. It's kind of hard to know. I got to guess, but I could be wrong. I'm not coming back on. And so that humility, I want to lay the challenge out to you. You want to inform your viewers? Then accept and embrace humility. And the next overconfident guest you have, shorten their segment, and the next person who says it's hard to know, lengthen theirs.
So limit Larry to like 4 minutes. 5? 5. Can we agree on 5? We'll agree on 5.
We'll go at 4.5.
You know what's great about Wolf is he showed up here at the end of the show here before we go to Christine Lagarde. He showed up with a case of Swan's Draught. It's great. That's
Good
like
lager.
this Australian beer.
Yeah.
It's a West Australian
Western
beer.
Australian
Yeah.
beer.
Nice.
It's a beneficial. Yeah, Qantas
Yeah,
turned me
good
on
stuff.
that. It's great.
Guarantee you're back on soon. I'll send the invite in like the next couple of weeks.
I look forward to
For
it.
more
Good to
than
see
4
you.
minutes.
Absolutely.
Thank you, mate. Justin Wolf is there of the University of Michigan. That wraps it up for us, TK.
It does.
In Jackson, Wyoming. Until next year.
You got the Gulfstream, right? Back
Ready to go?
east? Yeah.
Jackson
Okay.
Airport. Going to race over there now. I wish.
You know, it's wonderful to have Christine Lagarde with us coming up after her important speech. But the real thing is, I'm a complete mystery what her speech is going to be. How does she address where she and Frankfurt are right now?
She is in a tough spot. Looking forward to the conversation with Tom Keene and Christine Lagarde later on this afternoon. From Jackson Hole, Wyoming, the message from Chairman Powell. There's more work to do. Good morning.